This video is brought to you by forget it. If the money printer gets turned on to pump another 2 trillion into the economy like during this 2020 pandemic, after the banks have gone through the process of repeatedly relending that money according to the money multiplier effect, the altered base money in the economy could have an additional $100 trillion. We'll explain how this does actually add up, but first we'll take a look back at the history and cover the basics. The word economics comes from the Greek word oikonomia, meaning household management. So economics started with the wife budgeting every aspect of the household, and over the years it has become an ogre. I mean a cake, an onion. It has layers. We can see the forces of economics battling each other out at the individual level, within a firm, at the industry level, within a small neighborhood, and the list goes on. All of these can be categorized under micro and macro economics. And during a pandemic like the one we are facing today, can magical solutions be the answer? The money multiplier effect is one of the many magical mysteries that economics has to offer. And if you want to learn more economic spells, let me know in the comment section down below. Now imagine this. I go to the library every day and have become very close to the librarian, who is a lovely chatty lady. Yes, I'm not a cool kid. I mostly just hang out at libraries. Then, on my wedding day, she gifts me $1,000. It was just sitting under her mattress since the 1980s. I take this money and put it into my bank account. The money that I deposited into my bank account is an asset to me, but it is a liability for the bank. My bank has to pay the money back to me whenever I ask for it. The $1,000 become a deposit liability for the bank. To offset this liability, the bank has a system in place known as fractional reserve banking. Fractional reserve banking is the most common form of banking practiced by commercial banks worldwide. It involves banks accepting deposits from customers and making loans to borrowers, while holding in reserve a fraction of the bank's deposit liabilities for emergencies. Bank reserves are held as cash in the bank, or as balances in the bank's account at the central bank, your bank's bank. So what does the bank do with the $1,000 I just gave them? Does the money just sit in my vault? Nope. The bank lends the money out to those who are in dire need of loans. Banks don't keep all the money that you put in your account, they only hold a fraction of it, hence the name fractional reserve banking. Banks know that people are not going to suddenly come back and want to take out all their money. Now you may argue that they might, and that is what the fractional reserves are set aside for. So who decides how much money a bank has to keep in the safe box? The central bank. In the United States, that's the Federal Reserve System. In Canada, it's the Bank of Canada. And in India, that's the Reserve Bank of India. This minimum amount that banks are required to have is held in liquid assets. The liquid asset with the highest liquidity is cash, because it can become anything. It can become a shiny red Lambo, a vacation in Hawaii, a tiger, and how can we forget? Delicious M&Ms. How much of your deposit do banks keep in reserve? Large banks in the United States must keep at least 10 out of every $100 in reserve. That's 10% in the United States, and it's similar in other countries. This is known as the reserve requirement. Banks have the freedom to reserve more, but they cannot lower it below the minimum. If a bank wants to be more liquid, it will have to have a higher reserve ratio. This may happen if they are worried that their customers want to draw more money and people are not able to pay back their loans, say due to the 2020 pandemic. So, the reserve ratio can be more than 10% and can change over time. Fractional reserve banking predates the existence of governmental monetary authorities. It originated centuries ago when bankers realized that generally not all depositors demand payment at the same time. Because of this reserve, the banking system has a considerable impact on the supply of money. Now, imagine this. You go to your bank and deposit $1,000. Your bank is required to keep $100 in reserve, but can lend out the leftover $900 to me because I need the money for buying a new hard drive for storing my amazingly made videos. That $900 gets credited to my bank account. So now, this is the crucial part. There is $1,900 in deposits. Because bank deposits are a part of the money supply in the economy has increased by $900 because you deposited your $1,000 in the bank. So now I have $900 in my bank account. Yes, I spent the $1,000 my librarian friend gave me for the wedding on a microphone and laptop which I'm using to make this video. And my bank lends out 90% of my bank balance, which is $810 to Karen. She complains a lot. Now, the deposits have increased to $2,710. And suppose the bank holds 10%, which is $81, of Karen's money and lends out the rest, and so this process continues. As the bank gives more loans, the number of deposits increase, which in turn increases the number of loans, and this process continues, and while this process repeats itself, the money in the economy keeps magically multiplying. We can figure out by how much money in the economy has increased by the money multiplier process. This tells us how many dollars worth of deposits are created with each additional dollar of reserves. Any change in reserve ratio changes the money supply in the economy by a multiple of the amount changed. Think of this as a bicycle. When you pedal, a very small rotation leads to a much bigger turn of the wheel. So money multiplier equals 1 by reserve ratio. If we plug in some numbers, we see 1 by 20% is 5 and 1 by 10% is 10. What that means is that every $1 of new reserves will ultimately result through the money multiplier process to 10 additional dollars in the economy if the reserve ratio is 10% and to additional $5 if the reserve ratio is 20%. Now, let us talk about my librarian friend and why it is important that she gave me the money that she had kept stashed under her mattress. If she had given me a check of $1,000, she would be transferring money from her account to mine, which would be creating new reserves, and so we wouldn't see this multiplier effect. But the magician here is not my librarian friend, it's the banks. They can create new money by lending existing money. In other words, every time money changes hands, in a scenario similar to the one we talked about, money multiplies. This new money can be used to buy more financial assets, thus creating further reserves. However, we do need to keep in mind that this is not such a cut and dry process. 10% is the minimum reserve a bank has to maintain at all times. In reality, banks often keep more as reserves so they don't have to tell customers they do not have enough money to give them if they suddenly want their money back. Now, let us consider another factor. If Karen decides to keep the loan hidden in her safe box, and she is never happy with the employees of her bank and always wants to talk to their managers, in such a hypothetical, the money multiplier would be lower. And during pandemics such as the one we are facing right now, banks not wanting to loan and Karen complaining about her dissatisfaction with banks and keeping her money at home can happen at the same time. Both of these factors cause the money multiplier to fall. So Federal Reserves often push harder to increase the money supply during a recession than during a boom, which is happening currently. Not the boom, the Federal Reserve pushing harder to increase the money supply. That's happening. The math behind this gets a little weird, but it will explain the attention-grabbing $2 trillion example at the beginning. Setting aside inflation, of course, if the bank saves 1%, they keep $20 billion and lend out $1,980 billion. The resulting additional money is $100 trillion. Yet if they save 2%, they keep $40 billion, lend out $1,920 billion, just $60 billion less, then the resulting additional money amounts to only $50 trillion. And don't even get me started on trying to divide by zero, which is the minimum reserve requirement of Canada, UK, New Zealand, Australia, Sweden, and Hong Kong. According to this effect, in such cases, money can magically appear out of thin air. So I guess Canada and the other countries that have no reserve requirement can beat this pandemic easily, because magic. At a conceptual level, no more math, I swear. This model implies that banks have to wait until someone puts money into a bank account before they can start making loans. This would mean that banks just react passively to what customers do and that they wait for people with savings to come along before they can start lending. Then there was Karen, who didn't put her money in the bank, which caused drainage. Money multiplier is not constant. It depends on the behavior of the banks as well as the public. Occam's razor is the problem-solving principle that states that entities should not be multiplied without necessity. With that in mind, the money multiplier can be considered questionable at best. Canada and the other countries with zero reserve ratio cannot possibly make money out of thin air. The theory of money multiplier is a concise way of stating how a minor policy change affects money and inflation, assuming the central bank has complete control over market conditions. When in reality, central banks do not have 100% control over economic forces. As with many things, this should be taken with a healthy pinch of salt. It is an interesting phenomenon to think about while falling asleep, and it reminds me of how we are only 6 degrees of separation apart. If you want to turn your $2 trillion into $100 trillion, then subscribe to our channel so that we can grow our subscriber base like it was being put into the bank and they were only saving 1%. Okay, bye.